All right. Welcome, everybody, to the Ultimate Advisors Resource Podcast. Today, I've got a very special guest, James Hintz from HST Tax Advisory Group down in Houston. And I wanted to bring him on today because Jim, for maybe, I don't know, it's been at least the last 7 or 8 years, you've been doing some very interesting tax planning involving a very specific transaction, and it involves insurance as well. And I really like this. I like to talk about taxes. I like these creative type of strategies. And I think you've done some of the best job implementing it and working with a broad range of different clients. So before we get too far into it, I'm Jordan Pence, president of Advisors Resource Company, and we help advisors like you write more insurance. So, Jim, before we dive into the details or anything like that, maybe you can take a step back and give an overview of this strategy and
Sure.
what makes it so important with tax planning.
Right. Right. We're a little bit different than most CPA practices. We focus on tax advisory. And what that means, this was beat into me by my father, who was a CPA years ago, is in order to change the trajectory of how much you're going to pay in federal income tax, your tax planning journey starts at the beginning of the year, not at the end of the year when you're filing your tax return. And unfortunately, most CPA practices are processors, and I'm not being critical. It's just what it is. And normally, what you see is you bring your stuff in. I don't care if you're a business owner or an individual, they process your tax return. If they're doing your financials or your accounting, they're going to prepare the financial statements, they're going to prepare the tax return. They're going to go, oh, by the way, if you purchase this as business equipment, we can get some accelerated depreciation or a deduction for this equipment up front. Here's your tax return. This is what you owe. And by the way, here's four presents for you that you get to pay for the course of the next year. And we'll see you next year. And it doesn't work that way. Our practice is built really upon looking for ways to mitigate federal income tax. And I'm not trying to sell my service, I'm going somewhere. The problem with business owners, and primarily we do work with businesses because that's where the biggest um, opportunities lie from a tax planning perspective. You got to either be self employed, running a business, and therefore you have the ability to structure it to reduce taxes. Now, the biggest issue that I see for professionals and other people as they start generating a lot of revenue, meaning we look at two things: compensation, as far as how much money does it take to basically maintain your lifestyle. It's not a budget. Everybody has a different number. Some people live more frugally than others. If you're the type of individual that spends every nickel that they earn, there's no tax planning that's going to help you. It's what it is. You're just generating enough revenues to sustain your lifestyle. If you're like most people and most business owners, when that income trajectory from a consumption standpoint versus earnings, that delta grows, meaning that, say, if you need $200,000 to live on, but you're earning $1 million, that additional 800,000, if it's properly not structured properly, your business isn't structured properly, you're subjecting yourselves to almost taxation on that non-consumption income. It's almost double than what you need to pay. And if you could save 16 to 20% on $800,000 of income, $800,000 of income, that tax savings that you would have put it to the federal government is now in your pocket, growing, building wealth, building your business, wherever you want to apply it. But it allows you to take those dollars that you would have given away to the federal government and repurpose them to generate more income. Now, our structure we look at, we do
So,
some tax. Go ahead.
so hold on, Jim. Wait a second. So you're saying if you're consuming all of what you're earning, meaning you're spending it all, there's nothing you can do.
Well, there's not much you can do. I mean, you're going to look for specific deductions to take advantage of the tax code to reduce your tax liability. And there are things that you should be looking at, and that's where the advisory standpoint comes in. But from an ongoing perspective, if all you're looking for are tax deductions, then that they are going to come and go with the wind of Congress, because we've got the big beautiful bill that was just passed, and contained in that bill, it extended some tax breaks and created others. Those are, I wouldn't say one-time hits, but those are tax deductions. We start our tax journey looking at structure. Most of the business owners we run into, I don't care if you're a doctor, a lawyer, manufacturer, uh, most businesses are set up as S corporations. And if you ask why they're an S corporation, they have no clue. This is what my CPA, my attorney told me to be. S corporations, from a structure standpoint, are flawed. And when I look at this, especially as income starts to accelerate, because S corps only save payroll tax, they don't save federal income tax. So if your wage base is above the Social Security wage base, you're not saving anything. You may be saving some Medicare taxes, 1.45%. That doesn't move the needle
No.
when we can save much more. So it's not uncommon that we set up, and Jordan kind of alluded to it. I'm a big fan of what's called an MSO structure, a management services organization. What we tried to do is bifurcate the operating entity that generates revenue from the business side of the business, which basically pays the bill, operates the business, and does everything else to keep the business alive. Payroll, buying supplies, buying equipment, whatever it is those expenses and those operational expenses, we typically move from the operating entity into a business company. It's called an MSO, a management services organization. This structure has been around for years. It's nothing new. We
Yeah,
ran
it
into
seems to be very popular among doctors, but not as a tax planning thing, but more as a
Right. It
liability
was
thing.
primarily designed years ago by private equity for them to take ownership in medical practices as non-licensed individuals. And it still exists today. I mean, this is the only way that a non-licensed physician can profit from the revenue of a medical practice without violating regulatory issues, which if you violate it, the FBI gets involved, and it's very punitive. We use it purely for tax planning because, as I mentioned, S corps are pass-through entities. Partnerships are pass-through entities. They don't pay income tax, but they pass the net profit or loss directly to the partners or the shareholders of the entity. Even if you don't need that income, it's being picked up on your 1040. And in many cases, if the income is passive, you don't even get to write off the loss right away. So depending on the situation, it could be a delayed write-off too, depending how it's structured. So what we do to manage this is we set up a management company, MSO, that manages the business operations of your business. It's a separate entity than the operating entity. And there's two things it does. Number one, the business company we set up is a C corporation, has a 21% tax bracket. If it's a pass-through entity, it's not paying an income tax. So what we do is we take all the income that operating entity, business entity is generating, and we move it through a management fee agreement. So the income comes into the operating entity. It then deducts a management fee expense for that revenue picked up by your management company as management fee income. The management company then pays all the expenses on behalf of the operating entity, payroll, supplies, whatever it needs to operate. Any net profit then is captured at a 21% tax bracket. The
Okay,
biggest
so
issue,
we're
go ahead.
basically creating a deduction over here on the LLC or the pass-through entity, creating income on the C corp side.
Right.
and that's reducing the tax from the client's ordinary income tax rate down to the 21%, which in theory, if they're making a lot of money, could be as high as 37%.
And that's kind of the difference that we look at. But understanding the MSO to basically satisfy IRS purposes, it's got to have purpose. It's got to actually do something. And as long as it provides all the services on behalf of the operating entity, the IRS will allow that deduction from the operating entity, the income being picked up. Now, one of the
So
biggest
basically, as long as all those transactions are running through the C corp, is that the sort of
that's purpose. Yeah,
litmus?
that's purpose. But it also does two things, especially in professional entities such as the medical fields. What you're doing is separating the clinical assets from the business assets. So if the practice gets sued, your MSO is not part of the crime per se because it doesn't meet with patients. It doesn't provide any medical services. All it provides is business services, and it becomes the bank. That's where all the assets are. So if the practice gets sued, the doctors get sued, the MSO structure and anything contains can be out of that litigation. It could get named, but our
Yes.
experience, we can get it out of the litigation because it's not providing that medical
So
services.
so that
Now,
component of it is extremely attractive to doctors, I would
oh
imagine.
yeah, but it could be also lawyers or whoever, any type of business owner that has litigation. I'll give you a good example. We have this structure uh, uh, for a heating and air conditioning where they run trucks all over the place.
Yeah.
There's liability. Someone, and they hit somebody on a kid on a bike or maim somebody with one of their vehicle trucks. Now you got litigation. So if you can separate that business assets away from those operating entities, that gives you some cover for protecting what you have. Now, one of the biggest issues that we get, not an issue, but complaints or misunderstandings, and I hear this all the time. When the client's CPA, when the first time they hear this, they go double taxation.
I was
So
about to ask that. Yeah,
the
double
C
tax,
corporation
double
has to
tax.
pay income tax at 21%. But if you want that money, you got to pay tax on it too. I really don't care how many times something is taxed. If the overall tax rate that you're paying on that income is less than your marginal rate, you're still ahead. And that's what we look at because there are ways to get money out of C corporations that give you more planning opportunities than any other pass-through entity. And I'll give you a good example of this. Say you're plugging along and you've got all these assets built in the C corporation. And by the way, our
Right.
C corporations, what we do with idle cash, they have a brokerage account. They manage assets just like you would personally, but they're in the corporate name. They invest in real estate. They do all the same things that a person does, but their tax rate is less and they have where all the money is. So it's building wealth. But say this
So
individual wants
so I
to
guess
build,
the tax rate being less is a really good point because I'm starting off with 79 cents on the dollar instead of 63,
right?
right? If I'm
And
in
then
the
your
highest tax
opportunity
bracket.
cost and any earnings on that are taxed at a maximum 21%. So you're operating in a much more tax efficient environment. But
Good point.
ultimately, there is a time when you're going to want, or a client wants money out of that C corporation. And I don't care if you wanted $1 million today. If you needed, you wanted to buy a personal residence where you cannot make a business purpose for it. There's options there. And one of the options is if you know how to take dividends out of a C corporation, dividend taxes on a dividend can range from 0 to 23.8, depending on your marginal personal rate. On average, for most people, they're going to run around 20%. For dividends less than 250,000, because they're subject to net investment tax, which is an additional 3.8%, which is avoidable. And how you avoid it, if you needed $1 million out of your C corporation today, I could hand you a check today for $1 million, and then I could spread that cost over a 20-year period or a 10-year period. If I did it over a 10-year period, what we would do is give you a check today, no taxable income on your 1040 whatsoever. But starting the next year, you'd pick up $100,000 DIV, dividend, 1099 div, no no cash, but you're going to recognize that income over the next 10 years. Now you've got a 20% tax liability on $1 million distribution when you got all of it paid out to you at one time. These are just some of the options that we utilize to get funds out of a C corporation, and delaying the immediate taxation. The longer you delay it, the longer you have access to that capital. That opportunity cost is huge.
So,
Jordan also, go ahead.
well, I was just going to say, so if you take a step back, you're not recommending that everybody go out and convert their S corp or their pass-through entity to a C corp. What you're
No,
suggesting is do the optimal, which is have the C corp over here and then have your LLC over here and pass money in between them.
right.
And then
Because
now once you get into that C corp, you've got the ability to sort of throttle your income or move it back and forth, right?
that C corporation is a business company, so it can have multiple things that it does. I mean, we
Right.
have it can go and invest in real estate. It can go invest in another business. It can do everything you can do, but it's going to have more capital to do it. Um, but the issue being, getting money out of it, there's another option that we like because Jordan mentioned this. I'm a big advocate for split dollar. And if you know what this is a misunderstood transaction. I've seen it not done well, and there's some potential problems that can be created with this if it's not done correctly. And it's got to be designed properly. But if you do it right, the the avoidance of the dividend tax can be avoided entirely. And there's some imputed interest that has to be picked up. But based on our calculations, that imputed interest rate is dropping with the Fed dropping rates. Right now it's 4.22, and it's going to come down. The average since imputed interest has been around has been 2.44. So we're going to see some reduction there, but it takes about 30 years to equate the difference between recognizing a dividend and taking it through a split dollar transaction. That 30-year um, time frame, we're not even considering the return on the internal cash buildup in the insurance contract. So what that does, it gives you more access to your MSO funds, because if you set up a split dollar transaction, as you know, the insurance policy is owned by the owners of the business. The money
Right.
comes to the MSO to fund the insurance contract. When the MSO or the C corporation pays the premium, the owner picks up imputed interest on the premiums it pays. And I'll give you a good example. If it was $100,000 premium, the tax on that is 4.22%. So it's a lot less than 20 grand. And so if you look at the difference, the guy's already ahead when you figure what the cash value is. Year one, there's more cash value than there would have been if you would have took a dividend and recognized the tax. So typically, if structured properly, there'd be more than, the 80,000 in cash value. It's going to be higher immediately. And now that you've got cash in that policy, say you run that policy for three years or so, and you've got a surrender period of $200,000. That 200,000, I could take a loan out of that policy immediately and not pay any income tax. If I did that, I would then take 200,000 from my MSO and replenish that policy that I just took money out. So essentially what I can do is I can use that policy as a conduit to reach through it, pull money out of the MSO and get money out of my contract tax free at any given time, because I can do it over and over again. It's an access point. And if you don't need it, you let it roll. And here's the biggest danger with split dollar. You've got to set up a targeted funding and let these clients understand that they got to fund the contract at
Yep.
least for the first 5 to 7 years. If they do that, they're golden. And the more funds they put into it, the more their bank is going to be that they can pull out of their MSO or C corporation to avoid income tax. So insurance, if done properly, is a huge advocate from a tax planning perspective. We've got a white paper, and we explain to those clients, this is not an insurance play, this is not an investment play, it's a tax play. And if you model this correctly from a pure tax differential, you're dollars ahead. In many cases, tens of thousands of dollars ahead uh, in a very short term. So it typically takes about three years to break even, and after that, you're over the top, and it just gets better and better from there. So from a tax advisory, tax planning, C corporations paired with S corps or partnerships and done properly, we we allocate money you were giving to the federal government. Here's your funding already. We can find dollars to allocate to the insurance contract to give them more access to what they're doing. And essentially, if they're the type that consumes every nickel, they'd have to take almost 80% or 90% out of their net profits out of the C corporate each year just to basically break even. If they're not that type, you're just going to be that much further ahead.
That's a really good point. And so, okay, take a step back. If you're going to do the split dollar in conjunction with the C corporation, you establish a policy set up for cash value accumulation. So, like minimum death benefit, that sort of thing. It's going to be owned by, if I'm doing it, it's going to be owned by me as the business owner. My C Corp is going to pay the premiums. I pick up the imputed interest, which is I pick up that as income. It's not actually a tax. So like if on 100 grand at 4%, that's 4,000 of extra income. And the tax on that extra income is my tax bracket times 4,000. So it's not actually 4,000 of taxes. It's only the taxes on that
Right.
income.
Yeah. It's like an interest, almost like interest income. So on your 100,000, you'd pick up like a like a dividend of $4,222 right now. Uh,
It's
um,
nothing.
it's nothing, and tax on it, it's an afterthought. I mean, you don't even see that, but you understand it's cumulative. So every 100, now it's 200, now it's 300, 400. Even if as that accumulating that you've got that increasing imputed interest versus taking a dividend out of the C corporation, recognizing dividend treatment, it takes 30 years to make up the difference. That time value of money is huge. And most CPAs miss this transaction. They don't understand it, and they don't recommend it because they don't understand it.
That's
Uh,
true.
and so giving more access, having more flexibility, again, why we don't convert C corporations, there's some tax problems with doing it depending on what's on their balance sheet. But also, we don't know what the tax laws are going to change. Now, the 21% is permanent in the code. That isn't changing. It's not
True.
going to change. But you don't know if Congress, changes the rules again. Who knows? So, worst case scenario, you'll have a C corporation with a bunch of assets in it, and if they do change, then you stop using it and stop using it from a business standpoint. But you'll you won't liquidate it.
No,
That's a thing. What I'll bring up too quickly is we have a lot of people that retire with these C corporations. We repurpose them in retirement. They don't liquidate it. They carry it in retirement to manage their other business assets, their real estate assets, investment assets, whatever they're doing. They don't liquidate it until death do us part because they're going to pass it on to the next generation. So there's some estate planning opportunities that come with that are very beneficial down the road too. So it becomes an asset. It's really a big asset of what it is, and if you know how to use it and drive it, it's just going to help you keep more of the wealth that you've already worked so hard to generate through your working years.
it's a really good point. And I think one thing we sort of glossed over was the fact that if you do this split dollar, you take the money from the C corp, it goes into the policy. Now me as the business owner, I get all the gains on that policy tax free.
Right,
So not only am I and that doesn't go back to the C corp. I'm using the C corp's money, investing it on my behalf inside the policy that's growing tax deferred, and then I get access to it tax free.
right,
And we're
and
gonna
you have
see pretty substantial growth over a long period of time.
right, and just just to be fair, from an accounting perspective, the IRS has codified this transaction. They call it split dollar in the Treasury regs. On the books of the C corporation, it's going to be booked as a receivable, like a loan. It's a zero interest loan. But what you do is you collateralize that insurance policy, so the death benefit will actually pay. Part of the death benefit goes back to the C corporation. But there's different ways to retire those dividends too. So it's not a bad deal. You just have more options, and all that gain on those dollars, as Jordan mentioned, that's tax free internally, does not have to go back to the corporation, but the receivables there, and there's ways to deal with it that's still much more beneficial than not having it at all. Now, we don't advocate taking every dollar of savings and throw it all through insurance contract. That's why we use a multiple approach using um, structured dividends, having the split dollar, compensation. All these things help allow access to funds from multiple angles depending on the situation. So you want to have different things you can do at different times. But again, the concept of double taxation, throw that out the window, because if people that's what they're thinking, they're not really doing the math and they're not looking at this properly.
Well, and to add on to that, it's not just all about the accumulation insurance either. You could buy long-term care insurance and deduct the premiums for that through the C
Right,
corp,
right, right.
which you
And that
can't
and
do
that's another one. Because Jordan, you and I were talking about this. I have a mother she's 97 in a memory care facility. That's $9,000 a month. And
easily.
and her long term care that she bought in CNA pays $1,400 a month. That doesn't cover the bill. So I mean,
Covers
there's
about a tenth
products
of
out
it.
there that we can deduct from the C corporation as a deductible expense, and it gets some of that benefit. So there's things that if you know how to use that tool, it's very advantageous.
It definitely seems like the C corp is one of the most underused tools when it comes to tax planning. I don't really know why, because you know exactly how much tax you're going to pay no matter how much it earns. It's the flat tax. It's very straightforward. And then you get advantages like being able to do the split dollar, being able to do
Right.
the long-term care, being able to do all these things. Why do you think most CPAs ignore the C corp as a valid strategy?
So they can't get over that double taxation concept. They just get lost in the weeds. They're just not doing the calculations and looking forward. It's reactive instead of being more
Proactive.
objective and proactive and looking at what's the possibilities. And that's kind of where we're always looking forward. And if you structure these corporations the right way, you can actually manage some of the taxation too. And here's what I mean by that. M- All S corps and partnerships, for the most part, are going to operate on a calendar year basis. So 12/31, whatever that net profit that's going to be when you close the books in December, it's going to generate a K1 to the partners or to the S corp holders. We
Right.
we have our MSO, or the C corporation has a fiscal year end, and we typically set these up so their year end is September 30. Their year begins October 1. So up until October 1, we're moving only enough money from the operating entity into the C corporation just to cover the expenses. Beginning October 1, we reverse that, because when the MSO's books close, we want to mitigate how much 21% tax bracket we have to pay at that given time.
Right.
But beginning October 1, we start moving all that cash. And by December 31, we want to zero out as much of the cash out of the operating entity as possible. So there's mitigates or minimizes any K1 unless it's done on purpose. But then all those profits are going to be now sitting in the C corporation, and that fiscal year just begun. So you've got another 12 months to deal with it. So there's tax timing, which you don't have to two bites of the apple ever at a pass-through entity. You get one bite at it, whatever it is, it is.
Yep.
This way we there's a lot more planning goes on. So our clients, we're touching them all the time. I mean, right now it's real busy because where are we? We're in October. So what are our discussions? Make sure by December 31, you're moving all these funds over so that, you're not picking up additional income on your 1040 unless it was by design.
Yeah, and that gives you not only um another 12 months to decide what you're going to do with it, it also gives you another more than 12 months to actually pay the tax, I guess, as well.
Oh yeah, you get that deferral. So it gives you that ability. And again, paying income tax isn't a sin. Making least amount is what the goal is. And if you're making a lot of money, unfortunately, you pay some tax. It's the rate you should look at, not the dollar coin. And again, yeah, as your income accelerates, if you've got a $20 million net profit, 21%, that's a big number, but it all landed on your 1040, you'd be screaming because it double it. So it's not a bad deal because those savings you still have, again, generate more wealth and more revenue and so forth. So
Well, and I guess if something happens in your business, you might be able to buy something or whatever,
right, right.
you have more time to decide like, "Hey, I wanna make another investment," or whatever.
All right. And right now there's with some of the new uh, depreciation, bonus depreciation come back 100%. There's some tax plays or things you need to consider that will help you, again, offset some additional taxes.
Yeah, that makes a lot of sense. That makes a ton of sense. So, this seems this seems pretty complicated. What what do you think,
It
like
isn't for us, but we we like it complicated to a degree. It's really not that bad. It takes us about a year or so to transition someone into this structure. Yeah, there's some education that goes on, and again, a lot of times it's over and over and over again. We're very patient. We understand this. We know where the risks are. We know how to book the transaction. We know how to make sure things are done correctly. But it takes about 12 to 18 months to do a conversion. But by that time, the clients are understanding the structure. We're getting the phone calls. They're asking the right questions. And, it gets to the extent before they go buy something, they want to know, make sure that it's purchased here and how should we structure this for buying real estate? How do we do that? And all that stuff. And it's just a learning process that doesn't take that long.
yeah, I was gonna say, you know, when you're thinking about this, what type of red flags or yeah, specifically for the IRS, do you need to avoid or mistakes that people make if they're going to try to implement this type of
Oh,
structure?
use the good stuff. It's like, uh, you've got certain clients that want to take everything out in shareholder loans and never pay tax on it. That's a red flag because if you get through an audit and there's huge receivable, they might try to force a dividend treatment on that, and that we don't want to do that.
That's
So
a big red flag, loans to shareholders.
yeah, depending how big it is, having loans to surely is not, especially in split dollar, especially if you're picking up imputed interest. They're more interested in the interest component than you are the non-interest. Another one is making sure that, unfortunately, if your business entity is really generating a lot of profit, typically the value of the services provided can be in question of the management fee. If your net profit is running around 30% to 40%, not a problem. If your net profit is running between 50 and 60%, we may be limited how much we can use that management fee to zero out some of that income. There's very few companies that I run into that have a margin income greater than 40%,
Right.
even in the medical fields, and a lot of it's getting compressed right now. So there are some industries, especially in tech, that where you can see, the profits based on their margin income is just crazy. So that's where kind of the problematic things that we run into. But we've been through audits already so many times in this MSO structure. We had one that went through the management agreement, and it was set at 40%. They raised their eyes a little bit, but we can understand it. It's not, don't be, that pigs get fat, hogs get slaughtered. Just don't be a hog here. It's good enough structure to take advantage of it. Just don't push it to the very edge.
Yeah, yeah, there's no reason to get aggressive on something like
No,
that.
it's not. And it's
A lo
straightforward.
a lot of people bring up the accumulated earning tax when you start to talk about C corps. Is that a thing anymore, or is it
Well,
are the
it
people
can be. I've yet to see, and I've argued with CPAs. I've yet to see the IRS push a dividend. It typically is going to be, brokerage account. If you're holding everything in capital assets, it's not applicable. It's passive income on what they're looking at. So if you've got rental income from real estate and so forth, they kind of look at that. But if you get treated as a real estate professional, that gets thrown out the window again. So it depends. And just because you've got a lot of dividends in there, roll it through your split dollar, do other things to get it down. So there's structure in there. But again, I've yet to see this really forced. There used to be a bifurcation on the C corporation tax rate used to be different too. Top rate used to be 35%. So professional service and holding companies had a flat 35%. That doesn't exist anymore. It's 21%. They may try to force a dividend out, but again, if you run 7 years and all of a sudden they come back, they want to push some dividend out, big deal.
Yeah, it's really not that big of a
No,
penalty or,
no,
you
and
know,
there's
there
ways to avoid it too.
and are they mostly looking for, like, you just have straight up cash, or are they just looking for that
Not
you
cash,
t
passive, the type of income that's coming into it.
Okay.
Active income from a business is not considered. So if you've got businesses, I'll give you a good example. We've got a client that has an MSO structure. He's got, um, uh, he fixes, they're mechanic shops. So he's got three mechanic shops. He's got a rental company. He's got, some real estate company. He's got other things, but it's all feeding that MSO. All that active income doesn't count. It's only that rental income and these soft rental income to yourself doesn't count. And you don't want to have a lot of soft rental anyway, because I mean, what you deduct on one hand, you pick up on the other. You're not gaining anything. That just drove me nuts. You see these doctors that have all this rental income, they charge themselves enormous amount of rent, but I get a deduction on my S corp. Yeah, but you're picking up as income on your other side. So you're not getting anywhere. Up to the depreciation, big deal. It just doesn't, it's not helping you. They just don't do the math. But
It's
in
a
my
wash. Literally, it's a wash.
wash, and again, it's looking at the passive activity law. It's not issued. And another thing, understand too, if the C corporation invests in a real estate deal, it's a limited partnership, for instance. As an individual, you have passive loss limitations. So if it generates losses up until your basis, you can write it off. Anything that exceeds that basis, they're suspended until you exit that partnership. In
Yep.
a C corporation, it's active. $1. So if the C corporation receives a K1 and it's got losses, it offsets active income in that C corporation. It's no longer a
Wow.
passive activity. So there's
Wow,
some
that's a pretty
benefits
good
in that.
deal. Yeah, that's a pretty good deal, especially, considering you're still working with a higher dollar amount anyways. I mean, I'm still investing the 79 cents on the dollar.
Right.
Sounds
So
like
there's
there's a ton of flexibility here.
right. And again, we could spend a day going through the structure, but just as an overview, that's why I would say 99% of our business is with a C corporation structure, because that's the way we enter the market. Tax mitigation is how we get into our clients.
So what is an ideal candidate for this type of strategy, or who is an ideal candidate for this type of
Well,
strategy?
our target is any business owner that's got 1 million in revenue or greater. That sounds like a big number for some people. It's not. I mean, if you look at average business owners, um, and even 1 million revenue, we'll look at it. Because I'm going to tell you, most business owners, they graduate. What I mean by that, you used to open up and start a business. Most businesses are going to start as a sole proprietor. They'll form an LLC. Yeah, they won't tax the entity right away until they start generating profit. Once their profit gets above, or their income gets above 60 to 70,000, the first change that they'll make is going into an S corporation, because there is some tax savings from a payroll perspective. If you can set your W-2, say, to 25,000, the rest comes out as a K-1 distribution, you avoid payroll tax. So it's
Yep.
15.3, 7.65 for the employer, 7.65 is deducted out of your check. So there's savings up until the wage base.
Yep.
Once that income gets above that wage base, then you're saving 1.45%. Now, once the income that's being generated from a consumption standpoint is satisfied. So say my income that I want to live on is 250. Once I hit 250, now I'm looking at the net profit. If my net profit now is, 500, I've got 250 of I'm taking out. Now I got 250 that I'm really not consuming. Now it's starting to look like maybe we can save some taxes. And what we look at is the economics. Does the cost of the additional compliance, the bookkeeping, the filing of the tax return, and some of the time management, is the savings still net to your advantage? Because we run the math. If it is, that's something to consider. As that income accelerates, and assuming every business owner wants to make a lot of money, now if it's 500, now it's 600 or 700, now it's really making sense, because now I'm saving, tens of thousands to maybe 100,000 of federal income tax. Now it's paying for itself. And that's where the transition happens. So
S-
depending on where they are, you
Yeah.
can math to see if it
So
works.
so it's almost like if if I'm gonna move at least maybe a couple 100,000 or 100,000 into a C corp from my S corp or my LLC, then it's probably worth it to start considering this type of strategy.
Run the math, because the way we do it is we'll do an analysis based on the tax returns actually being filed. So if we grab your 1040, and if there's a schedule or a S corp, we can get that as well. Or if it's up, sole proprietor will put their Schedule C will be there. So we look at that 1040 and look at what's the amount of income, net profit coming in. So if we look at the W-2s that they're taking, because they have to take a W-2 with an S corporation, that's a mandatory thing. And reasonable comp gets into, I'm not going to go down that path, but
It's a big discussion.
yeah. Um, the Once we have a discussion with the taxpayer, how much income you need to really live on, because you need to look at what they're consuming to what are you paying out of your 1040, because some of the things can be paid by the corporation, vehicles and all this other stuff. But in a sense, find out what they're paying. One of the things you need to do is be a little conservative, because the client will say, "Oh, I only need 200,000 to live on." And his wife goes, "No, you spend money like, a drunken sailor." So you want to pad it a little bit. So maybe 250, so that when you run the calculation of the tax savings, it's realistic, because then we layer in the compliance cost to this to get to a really true savings. If that savings is 50 grand typically or greater, clients are going, "Yeah, I
Worth it.
need to do this. It's worth it."
Yeah, that makes sense. Yeah, I like the idea of padding those numbers too, because everybody everybody you talk to says, "Yo, we're pretty frugal," and then you open up the
Yeah.
books and it's a different story.
You get clients that say that, and then you look at, well, you're spending every nickel really you're earning. So
Yeah, yeah, it's a kind of a different story, isn't it? So If somebody's got a client that they think would fit this type of concept, can they reach out to you and work with your
Sure.
team to help come up with a plan?
Not a
Awesome.
problem.
Well, we'll include your contact information in the description. Any other final thoughts about this strategy or things that we need to be aware of, things that we need to think about? How
Yeah.
do we talk to clients about this, or how should we bring them into the
Well,
conversation?
right now, October 15th is next week. So 1040 extensions come to an end. Either you file late, you don't, or don't file at all. I've got some of those. Um, and so right now, talking about tax savings is always of interest to people, especially if they're writing big checks to the federal government. The way I look at it is, and the way I approach them, do you like how much you're paying to the federal government? If there's ways to legitimately reduce your tax liability, um, I mean, there's a service. We don't charge for the analysis, so we look at this as a way to get our clients. And if we find the right client, they're going to want our services because we know there's not a lot of firms that do exactly what we do. They're starting to, but they're still not there. They want to just process returns. We're beyond that. We're an advisory firm, so that's kind of our difference. Start with tax savings. Everybody's interested, and you're not selling anything. You're just trying to find ways to help them.
Yeah.
So, and I'm going to say one thing. There's been some stuff on in YouTube, and I actually seen some on some of the other social media platforms about trusts, using trust to avoid income tax. If your client's going to get involved with that, just tell them that comes with handcuffs because it's tax avoidance and it's criminal. And I just had a client call me again. They went to some meeting with some of these guys. I said, run away from this stuff. It's fraudulent. They're going to get you in trouble. Don't do it. And I see, that's crazy talk is what it is. There was
Someone
some
was
guys that
just
the federal income tax law is not right. You don't have to pay. And here's the real rules. Federal income tax is not statutory. It's not part of the Constitution. Don't go down that track because everybody owes income tax. I don't care. Trusts pay income tax. Everybody pays tax. And to say there's not, it's not true. Period.
someone just the other day was
Snake
trying to
oil.
tell me. Yeah,
Yeah.
someone was just the other day trying to tell me about common law trust or something like that, and everything's tax free. And I was like,
Yeah. Sure.
yeah, I'm
Sure it
not going
is.
to do it. You can
The
do it. I'm not
IRS
gonna
comes
do it.
in and all those guys run away and then you're left holding the bag. And the IRS goes after you as the taxpayer. They don't go, well, they will go after them as a promoter, but they're going to come at you first because you're dumb enough to listen to them.
I, I think half those promoters' games is let's make 10 million. We'll give 5 million back in fees to the government if we get caught, and we'll go about our way. I mean, that's
Come up with some other crazy thing. Yeah.
yeah, some other schemes. So, anyways, well, thanks a lot, Jim. If anybody has any questions, they can feel free to reach out to you. We'll put
Sure.
the contact information in there. And Jim, you're happy to work with any
Sure.
advisors or clients out there that want this type of advice.
Yeah,
So,
we do work nationally. We have clients virtually from California to New York. So we're based in Houston, but we do work nationally.
fantastic. Well, thanks again, Jim, and I hope everybody enjoyed this. Thanks.
Thanks.